Are YieldMax short ETFs doomed to fail? This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. Short or inverse ETFs are supposed to perform inverse of the reference stock. This means for every 1% the stock goes down, an inverse ETF should go up 1%. These ETFs usually don't own a single share of the stock they're shorting. They use the options and futures markets to bet against a specific stock. These ETFs do have one flaw that YieldMax did not account for. For a short ETF to perform well, the reference stock must decline in value. While these are great to buy right before bad news or bad earnings, if you hold it for longer than a few days, the reference stock usually starts to recover and continue growing. That means your inverse ETF is now going down in value. Stocks popular enough to have an inverse ETF cannot continue to go down forever without being delisted or forced to do a reverse split. So the inverse ETF gravy train runs out relatively quick. This is why most experienced traders will tell you inverse ETFs are not good investments to hold long term. On the contrary, the focus of dividend investing is holding them long term, and the mentality of most dividend investors is to set it and forget it. For this reason, the best dividend investments are those that also grow in value over time despite regular dividend payouts. YieldMax originally started with only synthetic covered call ETFs. Their strategy may not have been perfect, but they had that system down and the traders could implement it with some degree of reliability. When YieldMax began to dip into short ETFs, they did not come up with a true shorting strategy. They just inverted their synthetic strategy and called it a short ETF. While this did technically perform inverse to their YieldMax counterparts and function enough like their normal strategy that it didn't require their traders to be retrained, this did worsen the main flaw of short ETFs. YieldMax created an ETF that trends down in value most of the time, which means your capital is already disappearing. And they add to the problem by paying enough dividends every month to cause NAV erosion, which drops the share price even more and creates monthly taxable events. Unless they start one of these ETFs against a stock like Walgreens, which has been trending down for over a year, you're going to watch your investment dissolve before your eyes. Other short ETFs eventually have to do a reverse split to continue being listed. Because they're usually traded on bad days, many traders are able to profit from them. But adding the dividend and making that the focus of these ETFs encourages investors to buy and hold them longer than they should. Ever since I raised this concern in a previous video, I've occasionally seen comments from people using them to bet on black and red at the same time. Their hypothesis is that if the other goes up as one comes down, their total capital investment can remain stable as they collect dividends from both each month. Let's see what the numbers say. If we compare equal investments into both Tesla and Crash from the date of Crash's inception, because it is the later one, which is May 2nd, 2024, you can see that while Tesla made a positive total return of 3.47% in that time, Crash made a negative total return of negative 8.58% in that same time. So if you'd done this strategy, you would have had a net loss of 5.11% in total returns. If we look only at price returns, it's actually far worse. Tesla's price return is negative 27.85% and Crash's price return is a negative 32.59%. While the comparison of Tesla and Crash has the most historical data to pull from, it would be unfair to look only at those two ETFs. So let's also compare NVIDIA and its counterpart, DIPS. As we know, NVIDIA has been on a run for a while since its reference stock, NVIDIA, has also been doing well. If we compare total returns from the inception date of DIPS, NVIDIA has a total return of 21.11% and DIPS comes in at a negative 21.9%. This pair of ETFs appears to be better at keeping more of a one-to-one inverse performance, but even considering both dividends and price returns, you would still end up with a net total loss of 0.79%. In the interest of being thorough, let's also compare Connie and Fiat. Starting from Fiat's inception until now, Connie brought in total returns of negative 8.38%, and Fiat, its inverse counterpart, brought in a positive total return of 0.68% so far. If you did this strategy, you would have had a net loss of negative 7.7%. I'll let the numbers speak for themselves. What do you think of YieldMax's short ETFs thus far? If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.